For joining us at the August webinar. We have a minute before we officially begin, so we're going to let a few more people join on before we get started. For now, just sit back and relax for a moment. Thanks. Good afternoon, everybody. I'm Claire Toth. I'm here with my colleague, Elaine Phipps. It's the August Point View webinar. This month, we're talking about the tax proposals put forth by President Trump and former Vice President Joe Biden. And let us get going.
Okay. Thank you, Claire. If you could flip to—
There we are.
Our nice colorful schematic here. So as Claire said, today we would like to give you an overview on what we know about the proposed presidential tax plans and how they might play out. Note this is a nonpartisan discussion. Claire and I drew straws to see who would wear blue and who would cover the red. And I don't really own any red. It's not my color. So here I am in neutral white, but I will be speaking to Trump's plan. Joe Biden has provided more detail with his proposals as he is a candidate, while Donald Trump has recently spoken to some immediate actions to alleviate the COVID pain. So let's get started with what we know. Claire, next for you.
Okay, well, I wanted to remind people before we dug into it, if you have questions, there's a Q&A button. I think at the bottom of the screen. We'll address as many as we can after the presentation. We've also got a little poll about how you think the White House and Congress might be situated after the elections. So please vote in that, and we'll take a look again when we finish the presentation. So the big picture here is that both sets of proposals are aimed primarily at high-income taxpayers, though no surprise, the two candidates have very different approaches. And when we talk about high income, just a couple of thoughts, particularly for those of us on the East Coast with a fairly high cost of living. Only 1% of taxpayers in the country report taxable income of $500,000 per year or more. And 5% of all taxpayers report taxable income of $250,000 or more. So the vast, vast majority of people in the country are not going to be directly affected by either set of proposals.
Okay, so what we need to keep in mind is that what is proposed isn't necessarily what will pass Congress. The ultimate changes that become tax law depend on congressional votes. And for that, the makeup of Congress will really matter. Recent history has shown that major legislative change is only possible when the House, Senate, and presidency are in the hands of the same party. So this trifecta is what helped pass the 2010 health care plan, as well as the 2017 tax cuts. We do expect more specific details on the Trump-Biden plans as we move towards November. What we'll discuss today is what we now know. Biden has made more specific proposals, while if Trump has any new proposals, they're vague at this time. The 2017 tax bill was a highlight of his administration, so we really expect him to continue to promote the economic benefits of that bill. Claire?
And the other piece of this is to remember, even if what the candidates are talking about today doesn't get passed next year, there are plenty of tax proposals that percolate in the ecosphere for years before they're enacted. And a concrete example of that is at the end of last year, Congress passed a law that, among other things, said if you inherit an IRA from somebody other than your spouse, you have to pull everything out in 10 years rather than over your individual life expectancy, which had been the prior rule. And that proposal had been kicking around since at least 2015. My memory says prior to that, but I couldn't find details. The initial proposal had been a 5-year payout. So in fact, the 10-year payout was a little more beneficial to taxpayers, though many of them don't like it. Mm. Again, before we get into specific proposals, I want to go over a few background things. What I've got up here on this screen is the tax brackets for different income levels in 2020 for single individuals and for married couples filing a joint return. There are a couple of other filing categories, but these are the primary ones. All income, this is taxable income. It is not your total income. Taxable income is income after deductions. And what we've got to do is talk about a few different terms. When people say I'm in, for instance, the 24% bracket, which begins at $85,000 for a single person or $171,000 for a married couple, what that really means is the next dollar of income, or the rate on the highest dollars of income is 24%. It doesn't mean you're paying 24% of all of your income for tax. Most people have an effective tax rate that is far lower than the marginal tax rate. Here, for instance, a married couple earning $250,000 are smack dab in the middle of the 24% tax bracket, but they're not paying 24% of their income. First, they've got to deduct the standard deduction, which is almost $25,000. And then the first dollars of income are taxed at 12%, some at 22%, and then at 24%. So this hypothetical couple would have an effective tax rate of a little bit more than 19%. So when people are talking about tax rates, it's important to determine if they're talking about marginal rate or effective rate. The other thing when talking about tax burden is to know whether or not it includes employment taxes, which we're about to get to, Social Security and Medicare taxes, because not all, those only apply to earned income. They don't necessarily apply to all earned income. They have the effect of increasing the tax rate higher the lower your income. And in a couple of slides, we'll explain that. These are just my notes. And Elaine will give us some basics on Social Security taxes.
So Social Security taxes are a focus of both candidates. The current law has 6.2% coming out of the first $137,700 of earned income for employees, and the matching 6.2% is paid by employers. This wage base is inflation adjusted. So the shortcomings of the flat tax, as Claire just explained, is that higher earners essentially pay a lower overall tax rate due to the income cap. Conversely, lower income workers may pay more in Social Security dollars than they do in other types of income tax, such as federal, state, or city. So that is the conundrum. So in terms of the proposals, Claire will speak to Biden's.
Right. And recall, this is just Social Security taxes. There are also Medicare taxes. So when we talk about employment taxes, we talk about both of those. But both candidates are focused solely on Social Security taxes. So former Vice President Biden has proposed that the Social Security tax of 6.2% ought to be reimposed at earned income of $400,000 or more per earner. So it's unclear what happens to the employer's 6.2%, if it gets imposed at all, if the employer pays it, if the employee pays it. Again, there's not a lot of detail here. but this applies basically to salary and self-employment income. And it effectively creates a donut, if you will, between the existing wage base of $137,700 and $400,000 where there is no where there's no Social Security tax coming out. This $400,000 is not proposed to be inflation adjusted at this point, so that as the Social Security wage base itself creeps higher, the donut between the two will shrink. And this would be imposed per wage earner. So for example, a married couple who each earned $250,000 would not be subject to this additional Social Security tax. Biden has also said he's going to direct these revenues to increase Social Security and similar benefits for low-income retirees. There are some fairly scary statistics out there about the poverty rate among the elderly, particularly elderly unmarried women. It's something like 20%. So there's been some concern that there ought to be more benefits directed towards this group of people.
Mm. Okay, so Trump has mostly spoken to his defined payroll tax cut in regards to COVID relief. He would defer collections on these taxes, possibly for the remainder of 2020 or perhaps longer, and has floated this deferral for workers making either less than $100,000 annually or $2,000 per week, which would actually be $104,000 annually. So once again, the devil is in the details, and the details are not clear yet. There's no clarification on if these taxes need to be paid back or if the deferral will be permanent, although that's been hinted. This move would need congressional approval, which of course did not yet happen. So Trump has signed an executive order to implement. At this point, we don't know what is happening with it. It does require voluntary cooperation from employers. And at this point, the Treasury Department has not issued any guidance. So critics, however, have plenty to say about this proposal. First off, for the unemployed, either from COVID or for other reasons, they aren't earning a paycheck, so they don't have to pay Social Security taxes anyway. This will only provide relief for those lucky enough to be working. Second, when these taxes need to be repaid, and conventional financial wisdom says they should be repaid, that will present already stretched workers with a huge tax bill in the future. And then finally, if Trump does waive the repayment of this deferral or makes the cuts permanent, he may be undermining the Social Security system. The system is already underfunded, and cutting collections further could lead to continued crippling of this entitlement program, which many people count on. So we'll see what happens with this.
Okay, thank you. On to tax rates themselves. And this gets back to the difference between effective tax rate and marginal tax rate. One of the big things that happened in the 2017 Tax Act was that the top marginal tax rate was cut from 39.6% to 37%. Biden and the tax brackets are inflation adjusted each year, so these dollar amounts keep changing on us. Biden has proposed to restore the top bracket of 39.6% for high income people. I've seen that it's going to come back at $1 million of income, or perhaps may go back to the pre-2017 levels. Again, inflation adjusted, so figure around $500,000 for a married couple and more like $425,000 or so for a single person. As we do keep saying, the devil is in the details. Now, back to Elaine for a slightly more complicated version of Trump's brackets.
So under Trump's thoughts, what is currently the 22% bracket is proposed to become a new 15% bracket. So a taxpayer whose income meets or exceeds the very top of that bracket has the savings indicated in the chart. It is estimated that less than 20% of taxpayers could actually take advantage of this. The interesting thing is that the people in the 22% tax bracket currently pay 15% on the qualified dividends and long-term capital gains. So if this were to take effect, they would actually be paying the same rate on ordinary income as they do on the gains and dividends.
Mhm.
So it's a flattening of the structure, Clara, you would say?
Yes, to some extent. And that does lead us to capital gains taxes. This is the current structure where there is in fact a zero capital gains bracket, and then the 15% bracket into which most taxpayers fall. As Elaine just said, at the bottom of this bracket, these are the folks paying 22% in ordinary income. And then at the top brackets, at the high income levels, essentially the folks who are in the 37% bracket for ordinary income are paying 20% capital gains. And long-term capital gains taxes apply to investment to assets that you hold for at least a year and a day. And again, the rates are based on your taxable income, which means your income after all of your deductions. And continuing with this, Biden has proposed that for those with taxable income above $1 million, that there is no separate capital gains rate, that they pay ordinary income tax rates on those capital gains. And again, if we're increasing the top ordinary income rate to 39.6, then taxing capital gains at that rate instead of 20% pretty much doubles the tax on capital gains for the very high earners out there. And what this really means, compared to Elaine talking about Trump wanting to reduce the 22% bracket to 15%, is that Biden wants to make capital gains look like ordinary income, and Trump wants to make ordinary income look like capital gains. So that's sort of your big picture takeaway.
Okay, regarding capital gains, Trump has mentioned adjusting the cost basis or indexing all capital assets for inflation. So for liquid assets, we would expect brokerage firms to take the lead on tracking this basis adjustment. It will be very difficult to make adjustments on anything but publicly traded securities, particularly if there are other basis adjustments, such as there's been more investment or depreciation that's been taken also going on. This proposal would not apply to retirement savings and isn't needed for homes, and homes remain the largest source of wealth for most Americans. Trump has, as Claire said, indicated a willingness to collapse the capital gains tax to have everyone pay the 15% rate, essentially limiting the higher 20% rate wealthier Americans, defined as those with income roughly over $400,000, now pay.
And by way of really big nerdy tax picture, for as long as I've been practicing law, which is almost 40 years, there has been some intellectual debate about why a special tax rate for capital gains. The intellectual justification for it is that assets do appreciate over time simply because of inflation, and that the way to, rather than trying to adjust cost basis for inflation, just tax at a lower tax rate. Trump seems to be trying to do both here. The federal estate tax. For years and years, well, anything you leave to your surviving spouse, there is no federal estate tax. So the federal estate tax really only applies, or typically only applies at the second death. For years, it had been $600,000. The exemption that you could leave to somebody other than your spouse without paying tax was $600,000. It went up to $1 million about 20 years ago and has been ratcheting up steadily ever since. Again, with some some legislative jumps in the exemption amount plus an inflation adjuster. So in 2017, it was about 5.5 million, so that a married couple with some good estate planning could effectively leave $11 million before paying an estate tax. The 2017 Act effectively doubled the estate tax exemption. And so with inflation right now, a married couple can leave about $23 million to their children and other heirs with no federal estate tax. That 23 million is scheduled to be cut in half in 2025 for reasons of budget estimates. And as in addition to this exemption, most assets get what's called a basis step up in death at death. So if grandma bought 100 shares of AT&T in 1964 and rode with it through divestiture, through recombinations, through split-offs, through spin-offs, and has no idea what her what the original cost basis is anymore, well, when grandma passes away, it's all brand new cost basis, fair market value. We don't have to track that. That basis step up does not apply to retirement accounts or annuities and a few other similar assets. So that's the current landscape on the federal estate tax. Very few married couples die with $23 million between them. So very few people ever have to worry about the estate tax. Biden would propose to cut the estate tax exemption in half now rather than waiting 5 years. So again, our married couple can give away about $11 million. There has always been some grumbling that large illiquid assets can get caught in this problem, can get caught by the estate. Think a closely held business or a family farm where the property, the business is really valuable and you don't want to have to sell it to pay the estate tax. There have always been special provisions for those situations, though they could be beefed up in connection with cutting the exemption in half. More controversially, Biden has proposed to repeal that basis step up at death, so that whatever grandma bought the stock for is your brand new cost basis. That had in fact been tried in 1976 through 78, and it was a disaster. Unsurprisingly, most of the world had no idea what the original cost of the assets were. Technology has solved a lot of those problems. There's a lot better record keeping going on. Very specifically, since in the past 10 years, brokerage firms have been required to track and report the cost basis of assets. That proposal had been coming for quite a while, so many brokerage firms can go further back than 10 years. So I think that has made it much easier to deal mechanically with a no cost basis step up. And just for fun, if you were really paying attention 10 years ago, there was a very brief period with no estate tax, but limited basis step up. And George Steinbrenner died during that window with an estate worth 1.1 billion assets. And his heirs are estimated to have saved themselves $600,000 in estate taxes because of when he passed away.
That's a good bit of tax trivia, Claire. So President Trump's plan will save the estates of the well-off from the taxman, effectively making the expanded exemption permanent and allowing the step up in basis upon death to continue. So what that means, as Claire said, the large estates will pay no federal income tax, that 23 million, and the Treasury will not be able to collect capital gains on, I'm going to switch from AT&T to that Apple stock that grandma bought back in 1980. So really, he's proposing no changes to the current system.
Well, other than keeping it permanent.
Right.
Okay, we're going to touch briefly on corporate taxes, which is another sort of signature piece of the 2017 Tax Act. Prior to that law, the United States had one tax rate for all corporations, 35%, which was nominally about the highest among developed countries. And I say nominally because, again, we've got to look at the difference between the marginal tax rate of 35% and the effective tax rate. The effective corporate tax rate was more like 27%, and that was actually in line with many other developed countries. However, the 2017 Tax Act lowered the corporate income tax rate from 35% to 21%. There were also some incentives to bring back profit that had been kept overseas. I'm not capable of doing a deep dive into the corporate tax world, but in general, the idea had been that we were going to reduce the burden on corporations and they would spread the wealth to their workers. And instead, they raised their dividends and bought back a lot of stock. So Biden has proposed to restore the corporate tax rate, maybe to 35%, maybe just to 28%. It depends on what version of his proposals you're reading. He has also proposed to have a minimum tax on corporations. Many very profitable corporations managed to escape the income tax altogether. And so Biden wants a minimum tax on all corporations, regardless of whether they show themselves profitable for tax purposes or just on their books. And he does want to increase the taxes on corporate profits that are held offshore and not brought into the typical US tax system.
Okay, Trump has spoken to lowering the already lower corporate tax rate from 21% to 20%. In addition, he is big on deductions for essential industries and companies that choose to bring their manufacturing back to the US. This would include pharmaceuticals and robotics. The recent COVID supply shortages have brought this concern home. He is floating 100% expense deduction, but we really have no idea what this means in terms of specific deductions or what expenses he's talking about. I think the policy goal here, and it remains one of his stronger points, is to bring manufacturing back to this country. That is something he has tried to do with the previous corporate tax cuts.
Okay. That's kind of it for what the candidates have proposed. I did say at the outset that there are things floating around the tax ecosphere that take years to become law. And this is my candidate for the next tax that people aren't quite talking about yet. It's the financial transaction tax. And this would be a tax that gets imposed every time a stock, a bond, an option, or similar financial instrument is bought and sold. A financial transaction tax exists today, and it works out to about 2 cents on every $1,000 of trade. You don't notice it. It doesn't really show up in any kind of reporting. But there are proposals floating around to raise that to raise that effective tax from 2 cents to $1 on every $1,000 of securities bought or sold. The thinking is that this is a voluntary tax. If you don't want to pay it, you don't have to buy and sell securities. Further, it's projected that the top 1% of income earners, those making $500,000 a year or more, would pay 40% of the tax. However, it would affect a lot more people than just the 1% because it would indirectly flow through to every mutual fund in the world, except maybe money market funds, or every mutual fund in the States. And anybody with the 401k or an IRA, it would effectively pay some of this tax. I can't guarantee this is going to happen. And I certainly think if it does, it probably won't be as high as $1 per $1,000. But that's something that I keep your eyes on this. It would not surprise me at all if we saw this in the next 2 to 3 years. Elaine, you want to wrap us up?
Sure. Well, this is the Point View Management Team. For those of you who have joined us on previous webinars, you're familiar with our group. But we were pleased to be able to speak with you today on this topic. And if you are interested in speaking with us, we would love to sit down with you. We'd be happy to set up a complimentary meeting to discuss your finances, your investments, and your goals. So you see the information on the firm. So please reach out. We'd love to meet with you.
Okay. I'd like to remind everybody that we do have a poll that's going to close probably in the next 1 to 2 minutes. So if you haven't voted yet, please do. And please vote quickly, because at this point we've just so overwhelmed you with information, or perhaps we've made it clear that there are no hard and fast details in these proposals, but nobody has come up with a question yet. So perhaps Marcella, who is running the whole show behind the scenes, will you show us the results of the poll, please? Okay, so we asked what you think Congress is going to look like come 2021 or Washington. And slight majority of you think we're going to have divided government. We didn't specify who's going to be where. Next, a Democratic sweep. And a few of you thought that we might have a Republican sweep. So some of you will be right. And if we're getting ready to wrap up, but if you have a question following the end of all of this, please reach out to Elaine, me, anybody else at Point View. We'd love to take a deeper dive into this or anything else that's top of mind. Thank you very much.
Thank you.